Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report about a company that wants to help you trade stocks like a pro, but are they trading their own cards right? Let's decode what's really going on behind the scenes. Today we are looking at a report called an 8K. Companies use this form to tell investors about important events that could affect their business. In this case, it's about SK Growth Opportunities Corporation, which we'll call SK Growth for short, and their planned merger with Webull, a popular online brokerage. The main point of this report is to remind investors about something called incentive warrants. Think of these as a bonus for people who stick around and don't cash out their shares when the merger happens. Webull is offering these warrants to encourage shareholders to stay invested. So what exactly are these incentive warrants? Basically, Webull plans to give one incentive warrant for every share that investors choose not to redeem, meaning not sell back to the company when the deal closes. They are also giving 20 million of these warrants to some of Webull's current shareholders. These warrants let you buy Webull stock at a set price, which is initially $10 per share after the merger. There are a few things to keep in mind. First, to get these warrants, you need to be a registered holder of SK Growth shares on the day the merger actually happens. Second, the merger is expected to close soon after a shareholder meeting set for late March, assuming all the usual conditions are met, like getting approvals from regulators and the stock exchange. Now let's talk about some of the risks and uncertainties involved. It's important to remember that this report contains forward-looking statements, which are basically predictions about the future. These statements are subject to many risks and uncertainties that could cause actual results to be very different. Some of these risks include the possibility that the merger agreement could be terminated, legal challenges could arise, or shareholders might ask for too many redemptions, which could stop the deal from happening. Changes in regulations or the structure of the merger could also cause problems. Other risks include Webull's ability to keep growing and managing its growth, dealing with competition and changes in laws or regulations. Economic factors and other competitive factors could also affect Webull's business and financial results. To get a complete picture of the risks, it's important to read the reports that SK Growth files with the SEC, including their annual report, quarterly reports, and the proxy statement about the merger. These documents have more details about the risks and uncertainties that could affect the company's future performance. If you are considering investing, you should read the documents filed with the SEC. You can find free copies of these documents on the SEC's website. Remember, it's important to do your own research and not rely only on this report. Also, keep in mind that the SEC hasn't approved or disapproved of any of the securities described in this report, and they haven't endorsed the merits of the offering. Any statement to the contrary is a criminal offence. Now, for my take on this whole situation, it's interesting that Webull is offering these incentive warrants to encourage shareholders to stay invested. It suggests they are confident in the long-term prospects of the company and the merger. However, there are also some notable risks. The high level of uncertainty surrounding the merger, as well as the many competitive and economic factors that could affect Webull's business, means it is important to carefully consider all the information before making any investment decisions. Webull wants people to keep their shares, but whether that's a smart move is still up in the air. Thanks for watching. If you found this breakdown helpful, be sure to like, comment, and subscribe for more corporate deep dives. Let me know in the comments what company you want me to decode next.